Namaste, welcome to Arthaniti. National Statistical Office released the inflation data for the month of February 2022. Now, the inflation stood at 6.07%. The upper level inflation target set by RBI for the year 2022 is 4.5%. So, this inflationary data reveals that inflation is way ahead of the target set by RBI. There are high chances that RBI will step up its monetary policy decisions and increase interest rates to keep inflationary trends in check. Now, when RBI increases interest rates, it has a positive impact on fixed interest earning securities like your bank FDs. Those rates also tend to go up. Consequently, loans also become dearer. So, your rate on loans will also go up if RBI plans to increase rates to keep inflation in check. Basically, what this does, it sucks up the liquidity or excess cash in the market, and inflation is brought down to levels within the target set by the RBI. Right. Now, oil, which is one of the major factors which causes inflation, which was nearing $0 when COVID pandemic hit in 2020, today is somewhere around $100 a barrel, all thanks to the Russia-Ukraine crisis and the sanctions laid by various countries on the Russian oil. Now, India, on its part, Indian Oil Corporation, one of the major oil companies in India, has placed order for Russian oil for 3 million barrels of oil from Russia at 20 to 25% discount. Now, the total demand for oil in India is somewhere around 200 million barrels per year. So, this is very insignificant an order to make any difference to our inflation or rising prices. One more factor which adds to the inflation is food. The consumer price index, one of the first and foremost indicators of inflation, has 50% weightage to food and food items. Now, food items like wheat, which we use on a day-to-day basis, the costs have risen to more than 40% compared to last year. Ukraine is one of the biggest exporter of sunflower oil, and you know the problems with Ukraine, and you know the supply chains that are going to get hit, and the impact it is going to have on edible sunflower oil which we use for cooking every day. So you know where the inflation is set to go. Nowhere in the near future it seems a possibility that inflation will be tamed. So we have to brace ourselves for inflation in the near future as well as in a foreseeable mid-term future as well. So, what is the impact of inflation on our money? Well, the purchasing power of our money goes down during inflationary trends. If we keep on earning the same level of money, we will be able to buy less and less items if inflation is not kept in check. This is very, very evident from the milk that we purchase in our daily lives. Look at the amount, the prices of the milk and how they keep on increasing year on year basis, right? Likewise, petrol and diesel also see such inflationary trends where petrol 3-4 years back was not above 80 rupees a liter, today stands well above 100 rupees a liter. So you very well know how inflation works and affects the money that we have. It basically reduces our purchasing power. It also affects our investments, our savings and our spendings altogether. So what? Do we keep on getting poorer even if we are working? Why? Because inflation, which is not in our hands, has set in and it has reduced our purchasing power. Is that the only solution? We get poorer by the day? Well, no. Your investments will help you ward off inflation and sail smoothly over this tide if you make smart investments. Now today we will discuss various investment options which will help you earn a better return than the inflation, and that should be your target while making any such investments. Now the first investment that I want to talk to you about is equities, shares, right? Now with the corona and the lockdowns, many people turned to equity markets. Why? Because they were sitting at home. Maybe some of them have had lost their jobs, and that seemed to be a fair enough venture to earn some money, right? But equities is not gamble. It is not gambling, and if you look at it that way, it is a sure shot formula to lose your money. You have to be well researched. You have to be informed about which company you want to invest in, and equities should never be looked upon for short term windfall gains, right? Equity is always an option that you should keep in mind to invest for a longer duration of time. Now over a period of say 10 years, equity investments have given an average return of somewhere around 12 to 15% with 6.07% inflation. That is amazing kind of a return that you can expect, but you should have that much longer duration in mind when you invest in equities. I will repeat this again and again. If you are unsure about investing in equities directly, equity mutual funds are a way for you to earn similar returns. Real estate is also one investment option which will help you hedge against inflation. But again, you will need to give it a longer time span. Like equities, real estate also need you to be invested over a longer period of time to have better returns from it. While investing in real estate, capital appreciation should be on your mind and not regular rental income. It is common knowledge that the money that you have invested in purchasing, say, a residential flat or a commercial property or a vacant plot of land, and the rental income that you will get from these properties is way lower than what any other investment options would have given if you would have invested a the similar amount in say a bank FD or a mutual fund or shares for that matter. So real estates should always be looked upon for capital appreciation that they give over a longer period of time. One way to invest in real estates with smaller amounts. We all know the prices of real estates in India and how they have hit so high that it is beyond the capacity of normal people like us, right? You have to shell in over a crore of rupees even if you want to buy a residential flat, right? So one way to invest in real estate is through real estate investment trusts. Now I will make a separate video about how real estate investment trusts work, but basically they are companies who own or finance real estates in the country, and they give you interest or dividends like you get in shares which are tax free, right? So a good way that you can have exposure in real estate without investing a huge sum of money that you normally will have to. Look out for my video about our real estate investment trusts, right? Now the third option, first we spoke of equity or equity mutual funds, then real estate. The third option is gold. Gold is a metal that always glitters, right? Gold is conventionally used as a tool to hedge off inflation. When there are inflationary trends, when there is uncertainty in the market, gold will always rise. But we as Indians, do we look upon gold as an investment? Or do we look upon gold as a family wealth, as something which is passed on from one generation to another? Do we look upon gold to be sold if the prices rise tomorrow? That is one thing where our outlook towards gold is different from that of the world. Now, how do you invest in gold if you have, like if buying ornaments and selling them is not your cup of tea? Well, you have gold mutual funds, you have gold ETFs, exchange traded funds, wherein they invest in companies who manufacture or mine gold and they give you returns, right? So holding gold in paper form instead of ornamental form is a way wherein you can have exposure to gold in your investment portfolio. On an average, for the last 10 years, the returns from gold have been somewhere around 10 to 11%. One way to look at it also is, instead of investing in gold for a 10-year period, if you put in the same money in, say, a equity oriented mutual fund, it is going to give you higher returns. Anyway, you are not going to use those ornaments. Anyway, you are going to invest in gold only in paper form. So one option that you can always compare if you are thinking of investing in gold is compare it with a risky instrument like a equity mutual fund over a same period of time. See the returns. For the last 10 years, if you compare the returns from gold ETFs and equity mutual funds any day have fared better than gold mutual funds. You are going to get more money. So when the time comes to buy gold, you will have more money in your hands and maybe you can buy more gold, right? One other way to invest in times of inflation is investing in international markets. Now, international mutual funds are the best way you can expose yourself to international stocks or companies which are traded, say, on a New York Stock Exchange or a London Stock Exchange or any other stock exchanges in the world, right? If you want to invest directly, RBI and FEMA, Foreign Exchange Management Act, has laid down guidelines wherein you can invest up to $250,000 every year in these companies which are listed outside the country. But there is a lot of paperwork and a lot of permissions involved if you want to go directly and invest your money. One other way that you have is investing through the new international exchange by National Stock Exchange, which is started in Gift City in Gujarat. Now, through this exchange, what you can do is you will not get credit for, say, a Apple stock that you want to buy directly in your demat account. What you will get is an underlying derivative which is issued by the NSE exchange, IFSC. That is what the name of the exchange is. So this underlying derivative will be credited into your demat account and you will keep on getting bonuses and dividends as and when Apple announces them, right? So that is one way you can invest in international markets, but through international mutual funds again is the best way where you can have a little exposure in your investment portfolios for stocks outside the country. Last but not the least, you can invest in high yielding bonds. Now, how do you do that? You can invest again through bond mutual funds. There are various mutual funds, say like ICICI All Seasons Bond Fund or SBI Bond Fund, through which you can invest in. During inflation, when interest rates rise, bond prices fall. Consequently, bond yields go up. So, bonds become an attractive option to invest in inflationary trends. So to sum up, your investments, the overall returns on your investments should be more than the rate of inflation in the country, right? So never ignore these figures. You should always look out for the figures, the inflation figures that are published by RBI and target to earn returns which are higher than that inflation rate. What is going to happen if you keep on earning better than inflation? The value, the purchasing power of your money will go up, right? So your money will not reduce over a period of time. The value of your money will go up conversely. So what kind of investments, as I have told you, let's sum up once again: equity or equity mutual funds, real estate, gold, international investments, and lastly bond funds should be the target where you should invest in times of inflation. Yes, happy investing, keep on investing, keep your eyes and ears open and invest smartly. I hope my video has given some value addition to your investment journey. I was not able to do graphics on the video today because of the short time available with me, but I hope my video reaches you on time. And do question, do comment, do ask me questions if you have any on this video. Subscribe, like my channel and share my video. Thank you. Good night.